Good morning, everybody, and welcome to episode 3 of the second series of Crystal Clear Complex Cases. I'm Dan Morris, Key Account Director at Crystal Specialist Finance, and today, as always, I'm joined by two very special guests. So first and foremost, this guy doesn't need any introduction to, I imagine, any of you. We've got Roger Morris from One Savings Bank, and then also we've got the show pony of today and the show pony of the series, the tax wizard, which is John McCaffery of Alexander & Co. Good morning, gents.
Good morning.
Good morning, Dan. Good morning, John. Good morning, Rory O'Mara and everybody else who's logged in. I'm certainly this is going to be an exciting session, Dan, because there's so much going on in the market at the moment. And yes, we're so pleased John could come on. And just for everybody who doesn't know, John came on with 1 minute to spare, Dan, so we were a little bit worried, but he got here on time, so that's all that matters.
Well, he's too much of a celebrity these days. I mean, the first episode, the first series, he was on 20 minutes before, but now he's just, he's just a wanted guy. But no, thank you very much for joining. And again, as Rog mentioned, it's going to be a very, I'd say, educational session. What we are asking and challenging you to do is challenge John with any of your tax questions related to property finance, and we really are going to put his expertise to the test. Obviously, for those of you that have been on throughout the past two series, John is, again, one of the best, if not the best within his field. And he always comes out with some great information, some really good golden nuggets. And I certainly, as well as Roger, learn every single episode. So he's a great person to really pick his brains. Obviously, a lot's happened over the past couple of months since we last had one of these in April. Obviously, rates are going up, petrol's going up, food's going up, gas and electric's going up, everything's going up. But certainly one thing that isn't going down is the demand in terms of the property sector. I mean, for ourselves, we've seen a record month on month since the beginning of the year, and it's just getting busier. And again, speaking to us today, and John, it's going to give you hints and tips as to how to keep yourselves busy and ultimately where to look for business within the marketplace when certain stock and certain sorts of deals are drying up. So if I can please invite you to put your questions into the chat section or the question and answer section, actually, and we'll kick this off. But how's the past few months been for you two guys? And I suppose how's business been, really, which is where we always start.
Dan, the last couple of months now, specifically the last month has been about obviously tackling inflation with the increase in interest rates. And realistically, if you've been in mortgages, you haven't experienced a rate rise for 17 years. So an awful lot of the product teams within the lenders don't have the experience of knowing what it was like when interest rates were moving up to 15%, when we were about to leave the euro and have sterling on its own. And then that was a very period of volatility. What is good is that the Bank of England have committed to not increasing interest rates more than 0.25%. But I think that's kind of a bit of a seamless link into one of the articles I read in the Telegraph, Dan, was that the consequences of George Osborne's reforms of the removal of interest relief in private ownership. If you have a high rate taxpayer who has a buy to let, apparently the difference of 2% on base rate will remove all their profit from the buy to let because of the way that interest relief is calculated. And I think this poses a good question really to John, is that if I am, let's say I'm on 60 grand a year as a basic salary, I have a buy to let, let's say it earns me £1,000 a month. It's not particularly well yielding, maybe let's say a more London Southeast centric. And with that increase in interest rates that we know is going to happen, I'm going to be making no profit from that buy to let as it stands. Now, John, I've never received tax advice. I am married. Is it worth me coming, and this is just a hypothetical question, guys, is it worth me coming to see a tax advisor, John, and to see whether or not something could be done within that structure of ownership? What would you recommend? What would your wise words be?
It's always worth a conversation, Roger. Your chap there is a higher rate taxpayer. The yield isn't good. He's losing interest relief because he's a high rate taxpayer. So yeah, he's not making much, if any, in the way of profits. There is a possibility there that if his wife is a lower rate taxpayer, that transfer to his wife would actually increase the level of profit and give him all his interest relief back. Yeah. By doing that transfer. The other issue to consider, it's not necessarily a tax one, is right. So he's not making a great deal of profit on his rent, but what's the growth in that property? So is it still a good investment from a property point of view in terms of capital growth? Yeah. And then if it is, the question is then, do they sell out paying the 28% tax? Or do they keep it knowing they may be losing a little bit on the rental stream, but actually there could be some substantial growth left in that property?
Yeah, so if you had somebody who came in and it was where, so a lot of the situations, it could be that I was in a married situation and my wife was not working, not using tax position. Mm-hmm. So I think generalistically and statistically, a lot of the times we're seeing from our own book is they've got one property, they're an accidental landlord, the property was maybe in his name or he's bought in his name, or ladies, it could be in a lady's name, but the spouse is a basic rate taxpayer.
Correct.
So I know we've explained this a lot, Dan, over the series, but it is the most common solution of what can we do, John, and what would that journey look like?
Right. So let's say in that circumstance, it makes sense to transfer to the spouse. You've got to make sure, first of all, that actually that's something they want as individuals. I understand that's the most common issue you come across. One of the more common issues I come across is actually they think less about the tax, but actually about their personal finances. And there are definitely marriage relationships out there where they don't share assets and they don't share income, to their detriment in terms of tax planning, it has to be said. But that's their choice. It's always their choice. But let's assume they're happy to share assets. So what you can arrange to do is that you can transfer ownership of the property to your spouse. And for tax purposes, you can do it one of two ways. You could actually convey it to your spouse and legally transfer full ownership to your spouse. But that may cause you an issue from a lender's point of view in terms of having to remortgage. Or you can do something called a deed of trust. Now, deed of trust is where you transfer the benefits and the obligations relating to that property to your spouse whilst you retain legal title. Tax follows the beneficial ownership. So what would happen then is from that point forward, whatever, I'll come back onto this in a minute, if you transferred 100% of the beneficial ownership, then 100% of the income and 100% of the debt obligation from a tax point of view would fall on the spouse. And therefore you could make use of their basic rate band. They're getting full relief on the interest and paying significantly less tax. If they do take over the debt obligation, and that debt obligation is more than 125,000, there is a stamp duty cost, but it's basic stamp duty, not the higher 3% rate stamp duty. If there is split ownership, so you do a 99-1 or a 75-25 or something like that, the revenue take the point of view that whatever the split ownership you have, you're taxed 50-50. That is unless you submit something called a Form 17. And when you submit the Form 17, from the date of submission of that Form 17, the revenue will recognise the revised split of, say, the 99-1 or the 75-25, if you can prove it. And the proof that you have is basically the deed of trust or the conveyance.
And just for everyone aware, is that deed of trust, in theory, needs to be drawn up by a solicitor, but it certainly, John, needs to be registered as a Form A schedule notification on Land Reg. So what would happen is Dan's the solicitor, Dan does me a deed of trust, Dan would then register that deed of trust on Land Reg as a Form A notification, Schedule A notification, and then that original would come back and be submitted with Form 17. So the moment that the transfer goes through or the trust document signed, you need to go onto the internet, because Form 17 is an electronic document and it's electronically date stamped. At that point, you will, in theory, receive your specific share that's documented in the trust document, but you got 60 days to actually sign it and send that with the legal proof, which is a trust document, to HMRC. That's basically how I would explain my own personal process, John, when I've followed that advice. So I think, Dan, that to me summarises what potentially could be a conversation that brokers could be having with their landlords who are high rate taxpayers, realise they make no money, not to give tax advice, but at least direct them to a qualified tax advisor. What questions have you got, Dan? I know you've got quite a few.
Yeah, I've got a few. I mean, first and foremost, a bit of compliance. I'm not, and Roger's not suitably qualified to give tax advice. This is just information that we're both spouting off, so to speak. For anyone who does need or want official tax advice by someone who is suitably qualified, then John's the guy. But yeah, no, you're absolutely bang on in terms of guiding clients, giving information, because ultimately you are at the center of the transaction, really. If there's any questions, issues, concerns, complaints, compliments, it all gets directed to the broker, unfortunately. So these third parties get away scot-free with the information that they're giving. So we've had a few come in prior to the session, so thank you very much for that. John, again, they're all obviously directed at you. So we will start with higher rate stamp duty.
Yes.
When does it and does it not apply? Because there's quite a lot of whispers and stuff around when it is applicable and it isn't. But could you just, I suppose, iron that out and let us know when it does apply?
So, right, so higher rate stamp duty applies in a variety of circumstances. Okay. So let's look at an individual buying first. Okay. An individual buying a property will pay higher rate stamp duty if they already have an interest in a residential property and the interest they're acquiring in the second property is worth £40,000 or more. Okay. If you've got 2 or more purchasers buying a property and one of them has an interest in another property, then higher rate stamp duty will also be payable on the whole of that transaction. Yeah.
Mm-hmm.
If it's your first property, you don't pay higher rate stamp duty.
What about, I mean, you might be covering this off, but what about, for example, because we're seeing a lot of these transactions and clients coming to us, what about if you are a foreign national or an expat with no interest in a property?
Right, if you're a foreign national or an expat, you pay, there's an overseas additional stamp duty.
Okay.
So you can actually end up in a position, so the high rate stamp duty is 3%, but the foreign person will pay an additional 2% on top of that.
Okay, perfect.
Yeah. Now, we've covered this off before, but it's worth repeating. If you are considering buying a buy-to-let property as your first property, and you then go to buy your main residence, if you own that buy-to-let in your own name, you are paying additional rate stamp duty on your main residence, and you're not getting there are stamp duty reliefs available for first-time buyers buying their first property. So in those circumstances, before you buy the buy-to-let, you might want to consider buying your first buy-to-let in a company structure, if that is something you want to continue to do in the future. Companies always pay higher rate stamp duty from the first purchase onwards. And the occasions that you don't pay higher rate stamp duty are when husbands and wives are transferring properties between themselves, or the property isn't habitable as a dwelling. So you only pay higher rate stamp duty on dwellings. So if you're buying a property that isn't habitable, then you wouldn't have to pay higher rate stamp duty on that.
Okay.
John, can I just ask you a question? Because I've done lots of webinars over the time where this has been explained just purely how stamp duty works. Either it's been taken directly from HMRC's rule book.
Yeah.
But I often get it where I've heard from a broker, which is the customer just doesn't declare that the first property was a buy-to-let.
Yeah.
And I know, if I believe right, HMRC stamp duty return is in effect a self-assessment. Most lawyers will do it and ask the questions, but it is down, the onus is down on the individual to make sure the information is open, honest and correct.
Yep.
I have heard a few domestic arguments of where someone's asked me and I've given my belief and sent a copy of HMRC's rules to say that transaction at the end, how many properties will you own? And explained it the similar way you have and told them to quantify it and be open and honest with the solicitor and the solicitor give it. But I have seen situations where people have just either failed to declare that that first property was a buy-to-let and paid standard rates, or basically misled the revenue.
Yeah.
How how sophisticated is the revenue at actually following that through and working out that you do have a property at the moment, and this is in effect your second property? Are they pretty swift on being able to follow that through?
It can be. So it's the revenue. One of the few good things the revenue have available to them is a particular piece of software by basically at the touch of a button they can access up to 30 sources of information on you. So if they decide to have a look at you, they may not, but if they decide to have a look at you as an individual, at the touch of a button, they can pull up all your land registry records, any properties you're associated with, your certain financial transactions. They don't have access to your bank accounts, but they can request banks provide certain level of information. And if they see that your name is associated with 2 properties, they can inquire into it. And if they see you've underdeclared, they can apply some very, very hefty penalties.
Brilliant. So there is a chance where people could get away with it. However, if they get caught, the consequences are very severe.
If you deliberately conceal, not mistakenly, but deliberately concealed tax from the revenue, the penalty is 100% of the tax owed.
Perfect. Thanks, John. Sorry, Dan, it was a question that took a lot.
That's fine. I mean, another question, and it was for a case that I've done recently for myself. So, John, I suppose this is a big thing which is crossing a lot of people's minds, not so much at the moment, but it has done for years. So I've just transferred a property out of my individual name, a buy-to-let, to a limited company. It was owned outright, and it was valued, it wasn't massive, it was 80k, so just a little buy-to-let. And the solicitor that was acting on my behalf said, well, why don't you transfer that property out, but transfer it out at a very minimal value, or even zero, because there's no lending on it, so you don't need to transfer it to this new, or sell it as such, to this new company, because you don't need it for mortgage purposes. And with that, you can avoid the stamp duty because you won't have to pay it. Talk to us about how that's a big no-no.
No, that's not true. So in most cases, there's a bit of a misnomer on stamp duty. Stamp duty, people think is paid on value. It's not. Stamp duty is paid on consideration given. So when you acquire a property, on a, let's say, not like that circumstance, but let's say it was just for purchase from a third party, or on a intercompany, on a interspousal transfer. So because that's the most common example, you're not paying stamp duty on the value, but if, say, the husband or wife takes over a portion of the mortgage, because you've taken on the debt, you've given consideration, and therefore you pay stamp duty on the value of the consideration, right? That's different when it comes to what's called connected party transactions. Now, a connected party is, very broadly speaking, a party with a connection with a relative, right? But in particular, and it does only apply to company, where you control a company, and you would as a shareholder, that rule about consideration is overruled and market value is substituted. So if you transfer in a nil value or £1,000 value or something like that, for tax purposes, that's ignored. And you pay stamp duty and you pay capital gains tax on the market value of the property transferred in, regardless of what actual figure you have put in.
And when would they come after you for that tax? Would it be immediately? Would it be later down the line?
It depends what you declare.
So
if you put in incorrect returns, you would imagine that if you put £1,000 down on the stamp duty return or £1,000 down on your capital gains return, they will come after you straight away. If you don't declare, then it could take them a while to find you. But if they do find you, as I was mentioning before, the penalties are large.
Okay. Well, there we go then. No, that's a lot of people think they can kind of, I suppose, trick the system really, and it doesn't work.
Yeah.
Does it?
No, it doesn't work at all.
Dan, you're so right. I often hear so many solicitors are saying, or particularly accountants, would just transfer it through for a nominal amount. You own it now, you own the limited company, so we just do it with consideration and we push it through. What you'll see is if there is a mortgage arranged on it, the lender on in effect the transfer across, but because it's classed as a purchase, we will always insist it's being transferred at what is the open market value determined by the valuation. And that in itself kicks up a problem because people say, well, that's no good. It's not how the solicitor and the accountant want to do it, but it's what the law dictates. and a revenue would be a lender would be complicit in tax evasion if it allowed a purchase to go through at knowingly know it was undervalued, John, because we got a value saying it was 80 grand, and we're seeing that the certificate and titles saying that transfers going through at 60 grand or 40 grand. But we do see that a lot, Dan, and it's just something for brokers to be mindful of. It's got to be transferred in, as John says, at open market value.
Yeah, no, absolutely. Thank you for clarifying. Next question, and this relates to, again, a lot of transactions that we're seeing in a big shift in the market in terms of investors and what sort of property types they're going for. So we've got mixed use properties.
Okay.
So part residential, part commercial, etc.
Yeah.
Is the stamp duty applicable on that exactly the same as on a standard residential dwelling, or is there a difference in that?
No, there is a difference in that. So when you've got a mixed use property, the stamp duty rate is usually the commercial rate of stamp duty. So on your first 150, it's 0. Your next 100, it's 2%, and thereafter it's 5%. Okay. So there's often a benefit in these days to having mixed use properties, in that you would get the commercial rate of stamp duty as opposed to the standard rate of residential stamp duty plus the 3%. The one you've got to be a little bit careful of on commercial mixed use properties, flats above shops, not always considered to be mixed use properties if the flat has a separate access. Okay. So if the flat is accessed through the shop, that would all be deemed to be a mixed use commercial property. If the flat is deemed to be a separate dwelling, then you will have a commercial purchase and you will have a residential purchase.
Regardless whether it's on one title or not? It's
regardless, yeah.
Okay, and is there a discrepancy, or does it make a difference depending on the actual overall percentage of residential?
No, it doesn't actually. I mean, it's got to be a proper commercial element, but if you're buying properties on one title, or buying property with a mixed commercial residential use, then no, it's the commercial rate of stamp duty applies.
Okay.
Wow.
Amazing.
Well, that's a really good one. Dan, I've just had a question texting. Can I ask this one? Are you finished on your one?
Yeah, over to you in Birmingham.
So, John, with the impending potential consultation on EPC changes to buy-to-let.
Yes.
And we know that the journey, whatever happens, we've got to get our properties more energy efficient. So landlords are now looking at new builds. On a recent site where I was involved, 62% of properties went to investors and demand is high. So if I have got a bit of cash and I want to buy some buy-to-lets, I'm going to deleverage my property from Victorian and buy new build. That's my strategy. And I was going to buy on a new build site. So I could go to the builder, Dan Morris, the builder, and he would give me a contract for one contract for as many properties that I want to buy. So let's just say I wanted to buy 2, 4, 6, 8. What would you say from a stamp duty point of view, would you say someone should think about doing to make the maximum benefit from multi-dwelling relief? Because this starts to really come up a lot now, John.
Yeah, no worries, no worries. So multiple dwellings relief.
Yeah.
The way stamp duty was worked, so the multiple dwellings relief combines with another area of the tax legislation. So if you've got the same purchaser and vendor, and they have thought about the ways of capturing, well, I'm not the same purchaser because I'm using 3 different companies, or I'm not the same purchaser because it's my wife and my mother who are selling to you. They're all amalgamated together, right? So let's say you've got the same purchaser and vendor. That is deemed to be one transaction from a stamp duty point of view. So your guy who's buying 4, 6, 8 properties off a particular location, let's say, right?
Yeah.
You would traditionally have added together the value of all those properties to, let's say, give you a figure, I don't know, if you remember 250 each, let's say give you 2 million quid on an 8 property purchase. Yeah. And then you'd start paying stamp duty rates based on 2 million quid, which, as we know, are enormous. because you're getting up into the 12-15% on 2 million quid.
Yeah.
Right. What multiple dwellings relief allows you to do is, instead of paying it on the total 2 million, you pay stamp duty based on 8 lots of the average price.
Yeah.
So you're paying it on properties worth 250.
Yeah.
8 times, which comes in a whole lot cheaper than 2 million quid.
Yeah.
Now, if you're buying more than 6 properties, you've got a choice.
So when it's it, so if you're buying 6 or more,
sorry, 6 or more, not more than 6 properties. That's correct. If you're buying 6 or more properties, then you can choose instead to treat it as a commercial transaction.
Yeah.
Right. So let's say we're not doing 250, we're doing 500. Right.
Yeah.
So you're paying stamp duty at 500 grand.
Yeah.
Right. Now, when you add in the additional rates, you're looking somewhere probably at about 8% on some of those properties.
Yeah.
Right. So even when so what you do is you work out what 8 lots of stamp duty are, inclusive of that 8% rate.
Yeah.
Or you can choose to pay the 5% on the 4 million value less the first 250, which is at 0 and 2%. Yeah.
Yeah.
So 3,750 at 5%. And there's just a calculation to be done in those circumstances. Most of the time, most of the buy-to-let landlords I've come across tend to go for the multiple dwellings relief because their properties are of sufficiently low value as to not put them above the 5% rate. Even with the additional rate stamp duty. But if you're finding actually that you're buying several high value properties, it may be worthwhile at that point to then claim a commercial transaction.
And am I right in thinking with multi-dwelling relief, you don't pay the extra 3%?
No, you're not.
You know you don't pay the extra 3%.
You do pay the extra 3%.
You do, right. So you do pay the extra 3%. But basically your calculation is being 8 divided on the example given into 2 million, and then you just pay the second home stamp duty according to each of those into the values.
Yeah.
But where transaction is for instance 500,000 or more, then you would look at potentially commercial transaction relief when it comes
if
to
you're buying 6 or more properties. Yeah.
Perfect. Thanks, John. Very useful. Dan, back to Teesside.
Yeah, absolutely. And Rory's firing shots with this question, so thank you very much. Right, John. So, Mum wants to gift a 50% share of a residential property in Scotland to her only child, a son. Can the 50% gift be to a new SPV set up to hold the 50% holding, or does it have to be to him personally? He wants to reduce his tax liability. Which is the more effective transfer?
Well, in the circumstance, so there's a few issues to consider there. Now, widen it out slightly beyond the question, right? If she gifts the 50% share to a company controlled by her son, I think it is likely to be considered a connected party transaction due to the relationship between the mother and son and the son and the company. And so capital gains tax would be payable on the market value, and the company would have to pay stamp duty, land tax, or the Scottish equivalent, land and buildings tax, I think. Right? If she gifts it directly to her son, she will still have the capital gains tax based on market value. But because it's a gift, in this, you remember before I said the connected party thing only applies to companies? Because it's a gift, there is no stamp duty land tax payable by the son, unless he's taking over some level of debt, right? So if it's a genuine gift, then there's no stamp duty, land and buildings tax. But if he's taking over a debt or making any form of payment, then potentially there could be stamp duty land tax. Now, She may be doing this. It depends whether it's her property or...
There's no debt on the property. That's just
sorry?
There's no debt on the property.
Right. So if there's no debt on the property, then there's no stamp duty taxes to pay. If it's her property and she's trying to put it outside of her estate for inheritance tax purposes, she needs to be a little bit careful, because if she gifts it but retains full right to live there, it doesn't fall out of her estate for inheritance tax purposes. And if there is any gift where there's a benefit reserved, it's called a gift with reservation of benefit, kind of like originally, that still remains in your estate for inheritance tax purposes.
Again, news just in, it's a buy-to-let property, it's not a home.
Okay, so if it's a buy-to-let property and she's gifting half of that and he's getting all the rental income, after 7 years, that gift would fall outside her estate.
Okay.
Wow.
Now, the other thing to think about then is, you know, is that the son is, Stuart's just questioned in, the mother would pay capital gains tax based on the market value, not on the consideration, because the son is connected for capital gains tax purposes, so market value substituted. The other thing to think about is Rory's income. So we don't know what level of income Rory has, but if he's a high rate taxpayer, that would get added in. So it'd have to be a sizable amount of rent, I'd have to think, to make it worthwhile to put it into an SPV, but the income is another factor in there as well.
Okay, well, final thing, and I don't know if you can answer this on the basis of that information or not. Mum is a lower rate taxpayer, but is it best to gift him personally, not the SPV then?
Yes, definitely.
Okay. Perfect. Hopefully that helps you, Rory. Right, moving on to the next question, because we've got quite a few to get through. So, which one? Moving properties between a trading asset and an investment asset, what are the tax issues associated with this?
Right.
If that makes sense.
It does make sense to me. You will have circumstances where people, two circumstances. People build properties, intend to sell it and then keep it.
Yeah.
People buy properties to refurbish with the intention to sell it and then keep it. Yeah.
Mm-hmm.
Yeah.
Right. If you're a sole trader or if you're a limited company, okay. The other one is you've held a property for the longest time and then you decide to start selling them off. And to be honest, that applies more to limited companies than it does to sole traders. All right. So the trickier one is you've got a property you bought for refurbishment and then you decide, right, I'm going to keep it. Or you develop a property, you were going to sell it, and you decide, I'm going to keep it. All right. So in accounts, will you trade an asset? So whether it's baked beans or mittens or anything like that, a property is just another asset. If you are trading that asset, it is part of your stock, okay, which is what we call in accounts a current asset. Basically, a current asset is one that can be realized into cash quite quickly, okay? And for accounting purposes, you would carry that in your stock, with the idea being that when you sell it, the cost of that asset, the stock cost, is deductible and you're taxed on the profit, right? If you move it from stock and decide to keep it, that's then become an investment, okay? And there's a specific rule within tax legislation that says where you move an asset from stock to your fixed assets, your investments, you are taxed on the market value of the property at that time, right?
Yeah.
And that gives you a completely dry tax charge. You're paying tax on the profit you've not made and you still own. And therefore, you've got to give serious thought to when you're being a property developer or refurbishment, right? As to, right, am I actually going to move this on? Because if I'm not, you record it as an investment, because that is a nasty tax charge. There's no cash available and you are fully taxable on it.
But John, what happens though is if Dan and me build a block of flats,
Yep.
20 of them,
Yep.
and we then want to create the leases, Dan and I wouldn't mind keeping 3 of the properties.
Yeah.
Leases created, could that lease and title of those 3 properties be transferred into a new SPV without paying stamp
So what you do
duty?
in those circumstances is part of your property will be recorded as an investment asset in your books.
Yeah.
And the other thing is, and also you'd have the freehold interest retained.
Yes.
Yeah. And
Yeah.
then the rest of it would be
Yeah.
a sale of a lease.
Yeah.
Now, it depends on the terms of the lease. So if you're keeping those flats,
Yeah.
and it's kind of like short-term rolling leases, the 6 months, and then you just
Yeah.
keep going, right? That's always an investment asset for you, right? But if they are 150-year leases, what you've done is you've stripped most of the value out of that asset,
Yes.
right? So you would have recorded that as a stock asset.
Yeah.
Right? But yeah, you would split your accounts to show that actually I'm keeping 300 as a long-term investment and I've got 17 as a stock item.
And is it okay putting that into a new SPV? And because you're creating a lease, you wouldn't pay stamp duty, because you are, the only way to create the lease is to have a different legal entity. Am I right on thinking that?
Well, no. So what you would actually do is your property is still in the same legal entity.
Yeah.
Right? You're selling the lease to a third party. If you create the leases and move it to another entity, you've got your own disposal. You've created the lease, you've disposed of that lease, and actually you do pay stamp duty, yeah.
Right. Okay,
Yeah.
doc.
Now, the other way round is still nasty, but not as nasty. So if you move, so often you will have portfolios, and they decide, right, okay, I've had these for a long time now, and I'm just gonna cash in my chips and start to sell them down. So for accounting purposes, accounts have to show what's called a true and fair view, right? So if your assets are no longer investments, you have to move them into stock, okay?
Yeah.
Now the same thing applies in that moving from an investment to a stock asset, you realize the profit and you pay tax on the profit. But in that circumstance,
Yeah.
there's an election you can make to say, I'm only going to pay, effectively, it's more complicated than that, I'm only going to have to pay the tax when I sell the flat house to a third party.
So I'm guessing with that, would they have to do that prior to them being marketed?
No, I think it's a 2-year window you've got from the transfer. So once you've done the transfer, I can't say exactly, I think it's a 2-year window to make that election.
So they would essentially have them as investment, they would then sell them, offload them, whatever.
Yeah.
And then they would then have to move them over into stock. And then
Other way around, Dan. So you've got it as an investment, and then you decide and you're selling them off. They're no longer investment assets, they're stock assets. You're basically trading in them at that point. So you move them from investments to stock and then sell them from stock.
Right.
But it's only if it's over a couple of years, to be honest, because otherwise you just sell them straight as an investment. It's like, right, my intention is no longer to invest. I've cleared out all my tenants. I'm just holding these now to sell them on.
Right. Okay, perfect. Again, loads and loads of information to go out there. So you are literally an encyclopedia.
Go out occasionally.
Sorry?
I go out occasionally.
Yeah. Yeah, I hope you do, because otherwise your brain will explode. Is there any more live questions to come in? We've got a few more pre-asked ones. So let's talk about property used in businesses now.
Yeah.
Okay, so we're talking trading premises, guest houses, Airbnbs, and holiday lets.
Okay.
Is there any certain taxes or different taxes that are applicable or reliefs that are available given the fact?
There are. There are plenty. All of them have different tax treatments. So let's go with trading premises, right? Now, there's a commercial decision to be made on trading premises. Anybody who runs a business, if you're an entrepreneur, I see this scenario quite a lot. Generally, when somebody's purchasing your business, they don't want the trading premises, or they don't want the freehold of the trading premises. So what a lot of people might consider doing is keeping the trading premises in a separate vehicle or in their own name. And that may or may not work in the circumstances for kind of the following reasons. All right, so if you have a trading premises in a company and you trade from those premises, unlike in most circumstances, those premises are going to be free from inheritance tax. So there is a large benefit to you holding shares in a company that trades, and your trading premises are in that company, right? That's only the case if you die holding the shares, which some people do. And I'm not letting anybody have it, right? Set against that is the commercial risk of the fact that actually I want to sell my business, I want to retire, I want to take the cash. So therefore, do I hold the trading premises outside of the business? Now, if you hold a trading premises personally, and it's used in a business that you run or a trade of a company, you get 50% relief from inheritance tax. If you hold it in a separate vehicle, which you might want to do, because if you hold it personally, you've got the rental stream coming to you and you're going to pay a lot of income tax on that. You don't get any relief from inheritance tax because you've got an investment company holding property. Right? The other option to consider, and a lot of entrepreneurs do this, is actually, can I put my trading premises in a pension? Right? Pension is outside your estate for inheritance tax purposes. The rent goes in and it's tax-free. If you never touch it, you can pass it on to your successors, descendants, in your will, without a tax charge at that point, subject to certain rules. If you're convenient enough to die before you're 75, they can draw it out tax-free. If it's over 75, it's at their rate of tax. Yeah. But there's an awful lot to consider about trading premises, whether they should be in a company or outside of a company. The other benefit to a trading premises in a company, if you sell a trading premises in a company, you may well have a gain. There's a rule that still allows you to reinvest in another set of trading premises, either 12 months before, 3 years after, and shelter the gain in the new property. So you can actually defer your capital gains on those properties. So there's a lot to think about in terms of, and you can hold trading premises in one company with the trading company underneath. That works as well. But there's an awful lot to think about in terms of that. Your trading premises, the company, I often find, can incur the refurbishment costs or the fit out costs or that kind of thing, so it gets all the benefits of the capital allowances. But yeah, there's no one solution fits all in these circumstances. Trading premises is something people need to give a great deal of thought to.
Next, I suppose.
Go on, sorry, Dan.
I was going to say next. So we looked at trading, which is again a great insight into those sorts of premises. But what we're seeing, and I suppose what would probably be quite relevant to most people on this call today, is you've got an investor, they've got some cash. We'll look at pros and cons, but mostly you've got a standard residential property on this AST versus purchasing a property that's going to be let on a holiday let basis or B&B basis.
Yeah.
Which is the most beneficial from a tax point of view. We know which ones will be more beneficial from an income point of view. It's obviously short-term lets in theory, but the differences in tax and increase, or I suppose tax benefits of the Airbnb/holiday let versus standard.
Okay, so on excuse me, holiday let, there's an awful lot of benefits to a holiday let because the government likes tourism and people moving around and spending money in economies on tourism and that kind of thing. There are specific rules to qualify for certain tax reliefs as a holiday let, and it's called furnished holiday let. So if you've got a holiday let and actually you're using a bit and you let it out the odd week, it's not really going to work for you. But if you meet the specific rules of the furnished holiday let legislation, there's an awful lot of tax benefits you can have from that furnished holiday let. Basically, I can't remember the exact number. I always get this wrong. I think it's got to be available for let for something like 140 days a year or 200. I can't remember the exact figures. Basically, it's got to be available for let for a period and actually let for a goodly chunk of that. Following on from that, you can't let it to a single person for more than 31 days in a row, right? But that, if you do meet those requirements, that business is considered a trade for most tax purposes. So when you sell that property or sell the shares in the company that holds that property, your rate of tax on the first 10%, sorry, first million is 10% on the gain, yeah? And thereafter is 20% rather than your standard residential rates of tax. Other than that, there is some disagreement as to whether there are any further tax benefits. So with furnished holiday lets, I should also add furnished as well. So it's got to be furnished to a standard where somebody can stay in it. Furnished holiday lets will also come along with other services, right? So if people are providing other services, you need to have a care to the fact that actually if the value of those services goes above 85 grand in a 12-month period, you may need to just register for VAT and charge VAT on the additional services you're providing. The question around furnished holiday lets is often, though, the inheritance tax position. And the revenue will look at it. To qualify for inheritance tax relief, a business has to be wholly or mainly trading. And that means more than 50% of the activities are generated from a trading arrangement. And there have been a lot of cases taken to the revenue on things like holiday lets, caravan parks, lodges, because a lot of the value in those businesses is in the land itself. So you would have to demonstrate that you are providing significant levels of service, and a lot of your income is being generated from the additional services over and above the rental value of the property in order for the holiday let to be considered to be an IHT asset. I would say as a rule of thumb, not always the case, but as a rule of thumb, holiday lets wouldn't qualify for inheritance tax relief.
Okay. Perfect. Again, a wealth of information there, which is just phenomenal. I mean, does anyone have any further live questions before we wrap this up? Because we're nearly coming to the hour mark, and as always, like to keep this to an hour. So if you've got any further questions, comments, anything like that, then fire it away. Otherwise, we'll wrap this up. But I think I'll speak on behalf of all of us, really. That's been another informative session. It's been very diverse in terms of what we've discussed. But again, the main point to come out of this, as always, is just have a contact who is a tax wizard like John. Use John, speak to John. But there's huge benefits involved hooking up with someone like John, because otherwise you could be given the wrong information and advice. And as much as you're not, as I mentioned at the beginning, you're not a tax advisor, you're not qualified, you can bet your bottom dollar that if something was to go wrong within the transaction, whether it's to the solicitor, accountant, tax advisor, it's you as an advisor that's going to get nailed by the client. It's unfortunate, but ultimately you're the glue that sticks everything together. So again, hooking up the likes of John or a decent accountant, decent solicitor, it's definitely going to increase your levels of service. And as always, I mention in these, we don't get paid or we don't pay anything for John to come on these sessions. He's does it out of the goodness of his heart, bless him. And he's definitely one of the best, if not the best, in the industry. But I think we'll wrap it up there, guys. So before I do the final close, Roger, do you want to say any closing comments from today's session?
No, the only thing I wanted to say is obviously, thank John for his expert knowledge, and I'm pleased he did turn up because we'd be knackered without him. When it comes currently to the current situation in the UK mortgage market with rates going up and up and up, give the lenders, whatever lender you're using, the best opportunity of getting 100% of the information that they need in. So if you have got service delays 5-10 days, make sure when the underwriter looks at your case, they have 100% of what they need to issue the offer on that day. And I know within our group, we are able to underwrite for the first time and issue the offer on the same day, also because we do instruct vals. So think about helping yourself would be my finishing parting point. John?
No, just thank you for the opportunity. That was a lengthy, diversified my brain a little bit. So all to the good.
That's why he didn't turn up, isn't it? You mustn't have.
It was like, yeah, there's going to be hard on this one.
Yeah, that's it. And we'll be doing another one of these it'll be August now. Bloody hell. Which is madness. So again, we'll challenge John, so please get yourselves on and register when the link comes out. But yeah, just to mirror what Rog said, again, make sure the case is packaged to the best of your ability. And again, if you're putting cases through ourselves, we can help you and just put it in the best possible spotlight for the lender to get that quick decision for the client. I'm going to use a petrol station analogy, which I use at every single one of my petrol stations, at events that I attend or webinars that I do. We've all done it. We've all whinged about the price of petrol and how much it's going up by, and we've all queued, not for hours, but at a petrol station to save 5 pence a litre or £6 off your tank. But if your clients are messing about now thinking rates are too expensive and they don't know what to do and they're rubbing an iron, I promise you they're just going to keep going up. So we've got clients that we've got portfolio deals that are coming to an end of the term, or you've got the old Mortgage Express stuff, which at the moment is coming to the end of the term short. We then get the deals in, speak to these clients and let's secure the best rates possible for them, because we've missed out for the past few months, and by Christmas again, rates are going to be even higher than what they are at the moment. So if you're all like me and like to save money on petrol, let's speak to these clients and let's get the best possible deals for them, and let's keep having these conversations and keep ourselves busy. But that's it from all of us. So thank you all very much for joining. Hopefully you're enjoying the nice weather. We're not having to put the gas on and the electricity on, so that lamp behind me is getting turned off as soon as this is over. But thank you very much, and I hope you all have a great day.
Take care, guys.
Thank you.
Bye.
Thanks, Dave.
Cheers, Dave. Bye.
Thanks, everyone, for the kind comments. Enjoy the sun.